Welcome back. Let's take a look at an exercise, actually two exercises that deal with investment in debt security. In one case, we classify it as held to maturity. In the other, we classify it as trading security. All the information presented is exactly the same. It's a matter of how we do the accounting based on the classification we have for our investment. So let's look at the information given over here. We are told that Mills Corporation acquired a long-term investment of $240 million of 6% bonds dated July 1st on July 1st. The company management has the positive intent and ability to hold the bonds until maturity. That's for this exercise 12-2. Now, if it is 12-6, we're saying they don't want to keep it to maturity, they want to sell it, so they're calling it trading security. The market interest rate is 4% on the bonds of similar risk and maturity. We paid $280 million for these bonds. So again, let's take a look. The face value of the bonds is $240. Bond interest rate is 6%. Since the market rate is only 4%, we are willing to pay a premium. We paid an extra $40 million to purchase these bonds, which means we paid a premium of 40. 240 plus 40, we paid 280 for these bonds. The company will receive interest semi-annually on June 30th and December 31st. As a result of changing market conditions, the fair value of the bonds at December 31st, 2024 is $270 million. Now, if it's held to maturity, I don't care about the bond price going up and down during the life of the bonds. I intend to hold them to maturity, so I would ignore it. If it's trading security, I can't do that. I have to value them at fair market value at December 31st. So we'll see how we take care of that one sentence for trading security. For held to maturity, I'm going to ignore it. So let's see what we've been asked to do. First, we're told prepare the journal entry to record the investment on July 1st, 2024. It's going to look fairly similar in both cases. Investment in bonds debit, premium on bond investment, cash credit. The amounts were already discussed. I paid $280. The bonds, I will get back $240 at maturity. I have paid an extra $40, and that's a premium. I'm using the word premium. The premium in this case is not good. I paid more. It's actually a loss. It's a debit, but we call it premium. I paid a premium for this because I'm going to get a higher interest rate. Now, the journal entry over here for trading securities, oh, it's identical at this point of time. Okay, they both have the same. December 31st, I received my first interest payment. The journal entry is again going to look very similar. How much cash should I get? On the 240, I get 6%, but half of it because it's semi-annual. And that's going to be 7.2 million. So 240 times 6% times half is 7.2%. How do we calculate the interest revenue? Interest revenue is how much cash you paid is the beginning book value. So 280 multiplied by the market rate, which is 4%, multiplied by half. So interest revenue is going to be 280 multiplied by 4%, multiplied by half, that gives me 5.6. The balancing figure is the amortization that I have, 1.6. I will do the same thing over here, even if it is trading security. I paid a premium. I need to amortize that premium. Chances are I'm going to sell it very quickly. I probably didn't even keep it for these 6 months, but in this case, I'm telling you I'm keeping it for these 6 months. Now, December 31st, I'm told that the bonds are valued at 270. I paid 280. It's gone down by 10. It's valued at 270. What do I need to do over here if it's held to maturity? No entry. I don't worry about it. Well, trading security, I do need to worry about it. I need to make an adjustment. I need to see what the value of my investment is. So I have my notes over here and I'll share those with you. 280 is how much I paid for it. That's the beginning book value. I amortized it 1.6, the amortization of the bond investment. So now it is down to 278.4. So this was the book value. This is the amortization. That's the new book value that I have. Okay. So book value is basically, I'm looking at how much cash I paid minus any amortization I have over here. Okay, that's 278.4. In my books, I have it at 278.4. December 31st, it's dropped to 270. That's certainly bad news for me. 270 is a fair value. And so my fair value adjustment I need is a loss of 8.4. So I have an unrealized loss, which goes into net income, unrealized loss debit, 8.4, fair value adjustment, credit. Because it's trading security, I'll do fair value adjustment. I'm keeping this in my books because I'm going to get rid of this fairly soon is what I'm told. Now, if you read through the exercise, first was do the journal entry on the date of acquisition. Second is the when you record your interest, we did that. Third question is, how do you present this in the balance sheet? So in the balance sheet, for held to maturity, it's at amortized cost, fairly straightforward over here. Face value is 240, premium is 40, book value is 280. That's the number I present in the balance sheet. That's the date of acquisition, December 31st. It is 278.4. That's at book value we calculated over here. That's the same thing. Now that doesn't change. That first part doesn't change when we're looking at this over here. However, for trading security, I have this fair value adjustment. I said it's minus 8.4. Minus 8.4 will bring it down to 270. And that was the goal over here. I said the fair value is only 270. So in my books, I should show it at 270 at December 31st. Now let's continue reading. Last part. Again, same thing for both situations. For both, we're just looking at how we would do it if it was held to maturity versus trading. Suppose the Moody's bond rating agency downgraded the risk rating of the bonds and they decided to sell it for 290. Okay, so prepare the journal entry. I sold it for 290. Now I'm going to do the journal entry over here. Cash debit, 290. My bond investment in my books is at 240. That did not change. So let me highlight that here for us. My premium on investment, 40 minus 160. I need to take that out of my books. So let me see what I have over here. I have investment in bonds. That's a 240. I know how much cash I got, and that is 290. Premium on bonds, I have 40 minus 1.6. That will give me 38.4. And if you look at the debits and credits, or even if you just look at the numbers, what we know is we have a gain on sale of investment. So the 240 investment, the 240 bonds, we paid 280 and it actually jumped up to 290. So my investment, I have a gain of $11.6 million. Now what stays the same if I were doing trading security? The cash. How much cash I get, that's not going to change. Okay? That's going to stay exactly the same. The second thing that's not going to change is this investment in bonds. It's at 240. That number is the same. Okay. What's also not going to change is the premium on bond investment. Just like we did over here, the same number you have over here. So premium on bond investment, that number is not going to change either. Now, before I get to the last step of what I would do with this 11.6 million, let's hold our horses and see what we need to do over here. When you have trading security, and you're adjusting to fair value, what we need to do is we need to adjust it one more time. This is only a couple days later, but to the fair value, which is now the 290. From 270, it went up to 290. Okay. So I had paid 280. I said it had dropped to 270, which is why I had done the loss. Now I'm saying it's gone up to 290. So let me write this down over here. 290 is the new fair value. 290 is the new fair value. The old fair value was 270. So what I want is fair value adjustment of 20. Okay, I want a fair value adjustment of 20. So I have fair value, debit, unrealized gain, credit of 20. Do we all see what happened over here? When it's trading security on December 31st, I'd already done an adjustment and said, this asset, the fair value is 270. A couple days later, I want to adjust it again. Now I'm saying the fair value is 290. So that 20 going up from 270 to 290, I'm saying it's a gain. Okay. Now, when I actually make the sale, I do not show any gain or loss. So what account gets credited over here? Think about it for a second. I have fair value adjustment over here. Let me highlight this over here for us. And fair value adjustment over here. Take a look at the two. It's obviously one account. I credited, then I debited it. I have a debit balance in that account. I will credit fair value adjustment for 11.6. 20 minus 8.4 is 11.6. Take a look at this number over here, what we have. That's the exact same number. Remember, this is just how I did the counting in my books. But finally, the cash I paid, the cash I'm getting, none of that changes. So basically, your gain is 11.6. December 31st, even before I sold it, I lowered the value of my investment. Then when I sell it, I'm bringing it up to what the fair value is to show the adjustment over here. So depending on how I classify it, if it's held to maturity, December 31st, I'm going to ignore fair market value unless they tell me it's impaired. That's a whole different story in terms of how we would deal with it. Again, in advanced accounting, you deal with these topics, but not right now in the intermediate accounting class. So if it's held to maturity, December 31st year end, I ignore market value. Goes up, goes down, doesn't matter. I'm going to hold it to maturity. I'm going to take my 248 maturity. Only when I sell it will I recognize gain or loss. Trading securities, as long as I keep it with me, I need to keep making adjustments. It goes up, it goes down, I keep making adjustments in my book. So this is an example of debt security. Two different scenarios. One I said held to maturity. The other is said they're trading securities. So in our book, these are exercise 12-2 and 12-6. So with this, we should be able to work on our homework exercises.